Super easy. So what I want to do then is look for the entry, which is when prices correct between the greens. We saw this happen 1, 2, 3, 4, 5, and a whole bunch of other times here as it started flattening out, but it happened a bunch of times here. 1735. I just want to see what a difference 35 makes. Okay, there's 35. Okay, so basically it happened a couple more times, and then things started flattening out. No longer valid. Okay, so short here, short there, short there, short there, short there. Now, this all happened under 89, right? 88.95. And this went basically best case scenario down to about 88.75 or so. The actual low was 88.73. So you can, when I told you maybe 10, 12, 15, maybe 20 pips, you can see what I'm talking about as far as follow through goes. It's a nice little move, right? And what I did is I entered on the corrections. Okay, for example, in this situation, it was the area between 88.91 and 88.95. There's a 4 pip space there. So if you put your entry to short at 88.91, price have got to trade through 88.91 because you're selling, right? So price have got to trade up through 88.91 for you to get your sell because we're paying the spread, right? But with a 4 pip space here, we actually went all the way up to 88.96. If you put an 88.91 short, you probably got what you needed as far as the short trigger goes. The stops on this are super easy as well, okay? Because what you've done is you've got your entry signal here between the greens. You've got your exit signal up here between the reds. Okay, few rules. The area between this green and this red is no man's land. There's nothing to be done. Don't add. You don't have to get out. If you're uncomfortable, of course, get out, but you don't have to do anything other than just wait. It's no man's land. It's no fun. You're taking heat. Not a lot, but it's relatively boring, but there's nothing to be done. The trade's just kind of not doing anything yet. The lower of the two reds is your warning track. You can see here's my 34 EMA on the high. That's my warning track. That's letting me know that things aren't going well, and your stop loss, get ready. You know, it's just kind of a preparatory type step. The 55 EMA, the dark red, that is your out. That is your out. That means once you've broken that, now broken that how? By the spread, because your resistance should be at the 55. You don't want to get out at the 55. You want to get out basically 3 pips or so above it. Okay? You know your risk-reward ratio before going in. Here's how you know it. Could you use recent lows or recent highs? Sure. Could you use psychological levels? Absolutely. One of the easiest things you can do is go ahead and mark the 00, go ahead and mark the 80 pip, the 20 pip, the 50 pip on your charts if you want. You don't have to mark them. I mean, you should get in the habit of recognizing where you are around them, but in the beginning you might want to mark them until you get in the habit of realizing where you are in relation to these key levels. If you're fast on Fibonacci, if you're fast on Fibonacci expansions, that's what they call Fibonacci, the 3-point expansion, you could utilize those. I don't know where you are in terms of those skill levels, but if you're good with any of those, that's super easy way to do it. You can look at past highs and lows. Okay? You might determine, like for example, I would probably tell you after inspecting a trade like this, I'd be very hesitant to take some of these lower shorts. Like this short up here, I probably would be okay with, this 88.98 short, because I basically know that as we approach 89.11, 12 pips and I'm out. I know with an 88.98 short, I could probably ride it down to 88.80. Okay? I could ride it down to 88.80, and I'd still have a decent risk-reward ratio. That risk-reward ratio gets much worse the closer we get to 88.80, which is where at the time we had seen a lot of support. Okay? So this short up here, between 88.98, 88.96, I don't mind riding that down for about 16 pips, knowing that I'm risking about the same to the stop loss. It's about a 1-to-1 risk-reward ratio, which is pretty normal for realistic risk-reward ratios, not the ones we make up with a 10-pip stop and a 40-pip profit. I hear about those all the time, and they make me do nothing but laugh. If I'm using support and resistance, a 1-to-1 risk-reward ratio is pretty on, okay? I can see where we've run into support before, okay, based upon this prior low at 88.81. So it's not unrealistic that I might see the minor psychological level, okay? But like this short here becomes exceedingly worse. And the lower I get, my risk-reward ratio is just not looking good if I think that support's going to be kicking around that 80 level. Everyone follow? So just because we've gone between the greens doesn't mean that it's always going to be a great trade. You have to still think about the risk-reward. Luckily, because everything's based upon moving averages, it shouldn't take you but a few moments to sort that out. So basically, once you've set this up, save each template, okay, with the 13, 21, 34, 55 in the background, and then put these charts together. The blue one, of course, is for your trend. The green is for the mark up. The red is for the mark down. All right? And then just save the whole thing as a profile. And anytime you want to jump over to 5-minute trading, that's it. Again, profit targets, well, your stop loss is taken care of for you with the warning track and you're out. Okay? Your entries are pretty much mechanized because of the moving averages as well. Your profit targets, it's going to be really key that you observe near-term lows and near-term highs. It's going to be really key that you recognize where you are in relation to the major and minor psychological levels. You probably won't need to do much more than that. Like I said, if you're really good at a Fibonacci expansion, I've had a lot of good luck with that as far as projecting downside support and be a little bit more aggressive about looking for lower lows than, say, near-term lows, or higher highs than, say, near-term highs. You know, what if we take out this 80 low? Where were prices to go? That's where those expansions really come in easy. All right, great question. When do I use this? Fantastic question. I do not do this with economic reports. Too much volatility. This is not a strategy that's great with a lot of volatility. In fact, it's better when the market on your 15, 30, 60 is range bound. When you're not getting follow through on the other time frames, this is the place to go. Okay? So when the other time frames are just kind of wishy-washy, not going anywhere, you know, you're getting whipsawed and you're getting very frustrated by a lack of setups, this 5 minutes, fantastic. So not in front of economic reports, not during economic reports. Okay, in fact, I like lower volatility with this particular setup, not higher, because if I have high volatility, I might as well go manage that with a longer time frame if I think I'm going to get the follow-through that the volatility will bring. In those environments where you're consistently being frustrated by the lack of follow-through and the lack of price movement to set up trades on those longer intraday time frames. Everybody clear on that? There's a specific time to do this, and I think that's the best time to do this. Okay? So it's not terribly complicated. You saw the setup. I walked you through it. Not tough. You got the wave on the blue chart, and you have those Fibonacci-based moving averages on the red and green. Okay? And as far as near-term highs and lows, that's just a fancy way of saying what was the last low or the last high that prices reversed from. You can see how we did it on the dollar-yen. What I'm hoping to do maybe, and I'll talk to IBFX, is maybe during the week I can ask them for maybe a 30-minute session in the chat room here, and we can do a during the day session with this in particular. And I'll ask them, and they'll broadcast that as an event on the website. So maybe that's something we'll do in the coming weeks. But the setup itself is super easy, gang. Don't overcomplicate this. I cannot imagine a setup any easier than this. Okay, but the whole thing is dependent upon you finding that 12 to 2 or 4 to 6 o'clock cycle on the 5-minute chart, on this blue chart. Don't force that. If you force a bad trend, if the markup or markdown is weak, the whole trend is not, the whole setup is not going to work as well as it would if you're dealing with the strength of the trend. So that's the one thing you really need to be aware of. Don't push your luck on the trend. Basically, because you're getting 12 new candles every hour, don't worry about forcing the trade. You'll have a setup. Okay, you'll have a setup. Look for reasons to not take a trade, gang. Don't look for reasons to take a trade. Okay? You should be long because you're bullish. You should be long because you're bullish, or you should be short because you're bearish. Okay? All right, gang, so this has been a long time together talking about markets. I humbly thank you for your time. I'm just blown away. So thank you, And hey, when we do this again, I'll see you then, all right? Okay, take care.